The grid as the new bottleneck, mapping hyperscaler CapEx beyond the chip by value and momentum portfolio. Let's turn to a major shift happening in the AI space. The electrical grid has emerged as the new bottleneck for growth. Investors have spent a lot of time focused on computer chips, but we need to map where the hyperscaler capital expenditures are going next. That spending actually cascades into four specific areas, which include power generation, grid infrastructure, thermal systems, and site engineering. Our focus is on identifying the primary beneficiaries across these verticals. We want to measure their revenue capture and find asymmetric setups for investors. When a major cloud provider announces a new budget, that capital expenditure acts like a waterfall flowing through these four distinct layers. Each layer has its own competitive structure, typical margin profile, and level of revenue visibility. Today, we are going to map out that landscape. After that, we will quantify the actual revenue capture across these sectors and identify where the broader market might be mispricing these assets. Let's look at power generation. Often these companies cannot secure grid connections fast enough. When that happens, hyperscalers simply procure their power generation directly. This shift has reopened the United States gas turbine market. That brings companies like GE Vernova, Siemens Energy, and Mitsubishi Power into focus. We are also seeing a revival in behind-the-meter nuclear power agreements. You can see this in the Constellation and Microsoft deal to restart 3 Mile Island. We also see it with the Talen and Amazon setup at Susquehanna, along with Vistra at Comanche Peak. This push for direct power has also accelerated contracts for small modular reactors. Companies like Oklo, NuScale, and X-Energy are active in this space. However, it is worth noting that commercial deployment for these smaller reactors remains a reality for 2028 and beyond. Now let us move to grid and electrical infrastructure. This area requires heavy physical equipment, both inside the data center fence and out at the local substation. Components like switchgear, transformers, busways, and uninterruptible power supplies form the backbone of this setup. Right now, we are seeing notable delays in getting this hardware. Lead times for medium and high voltage transformers have stretched from roughly 50 weeks in 2021 to 120 plus weeks for 2025. The supply of switchgear faces similar constraints. Because this market remains structurally tight, these equipment providers currently hold clear pricing power across the entire value chain. Next, we need to discuss thermal management and cooling. Data center racks packed with graphic processing units generate a substantial amount of heat. For instance, the NVIDIA GB200N VL72 setup operates at roughly 120 kilowatts per rack. Looking ahead, future Rubin platforms are targeting 250 kilowatts plus per rack. Because of this intense heat profile, direct liquid cooling is no longer just an option. It is now a strict requirement. This shift has fundamentally expanded the industry. As a result, the total addressable market for liquid cooling has grown roughly 5 times since 2022. Several specific companies are stepping up to capture this new demand. Vertiv currently leads the market for coolant distribution units and rear door heat exchangers. At the same time, nVent is actively gaining market share in liquid cooling manifolds. We also see Modine carving out a solid position in single-phase liquid cooling systems, particularly after they acquired NAPS technology. Finally, let's look at site engineering and construction. Engineering, procurement, and construction firms work alongside specialized electrical contractors to actually execute these builds. In this space, companies like Quanta Services and MYR Group handle the bulk of the transmission interconnection work. At the same time, Comfort Systems USA and EMCOR have developed specific expertise in mission-critical mechanical and electrical systems for data centers. We also want to highlight Comfort Systems' modular subsidiary, Summit Industrial Construction. They prefabricate entire electrical rooms and mechanical skids off-site. This modular approach acts as a meaningful margin lever for the business. That strategy is increasingly important because securing available on-site labor has quickly become a binding constraint for these projects. Revenue mapping. How much CapEx reaches whom? When we look at hyperscaler capital expenditures, we need to remember that this spending is not a monolith. Historically, roughly 55 to 65% of that budget went straight into IT equipment, We are talking about servers, networking gear, and storage. That money flows directly to companies like NVIDIA, Broadcom, Arista, and various original design manufacturers. For our 2025, we are looking at a total capital expenditure base of approximately $350 billion. Out of that total, IT equipment will account for 55 to 60%, which translates to a value of approximately $190 to $210 billion. This category now also includes AMD alongside the other major hardware names. The remaining portion of the budget is what we call facility CapEx. This is the capital flowing to the physical infrastructure companies. Right now, this facility share is expanding. As compute density per rack rises, the requirements for power and cooling scale superlinearly with that density. Let us break down where that facility spending goes within that approximately $350 billion base. Securing the physical space through land, shell, and civil engineering takes up 5 to 7% of the total budget. That represents approximately $18 to $25 billion going to local construction firms and EPC contractors. Next, we have to power those facilities. Power generation and grid interconnects account for 8 to 11% of total spending, which is a value of approximately $28 to $38 billion. Companies like GEV, Eaton, Schneider, and Quanta are the primary recipients here. Once the power reaches the site, electrical distribution becomes the next major expense. Switchgear, uninterruptible power supplies, power distribution units, and busways make up 9 to 12% of the budget. That is a approximately $31 to $42 billion segment, primarily benefiting Eaton, VRT, Schneider, POWL, and HUBB. Keeping everything from overheating is another distinct category. Cooling systems, including chillers, CRAC units, and liquid cooling, take another 5 to 7% of the total. That equals approximately $18 to $25 billion flowing to vendors like VRT, NVT, MOD, and Munters. Getting all this equipment installed requires mechanical and electrical contracting alongside commissioning. That accounts for 4 to 6% of total CapEx, meaning approximately $14 to $21 billion goes to contractors like Fix, EME, MYRG, and EMCOR. Finally, software, networking fiber, and miscellaneous expenses take the last 2 to 4%, which adds up to approximately $7 to $14 billion spread across various other vendors. When you combine all these non-IT categories, you get the total facility CapEx for 2025. This combined spending amounts to approximately $110 to $165 billion. To put that into perspective, this specific market is now larger than the entire global power equipment industry was just 3 years ago. Let us look at the build economics from a unit cost perspective. Constructing an AI-grade hyperscale data center costs roughly $11 to $14 million per IT megawatt. This figure covers the facility itself and entirely excludes the cost of the GPS. We can break down that per megawatt cost into 4 main operational areas. First, electrical infrastructure requires roughly $3.5 to $4.5 million per megawatt. This budget pays for heavy equipment like switchgear, transformers, uninterruptible power supplies, and generators. Next, the mechanical and cooling systems cost roughly $2.0 to $3.0 million per megawatt. That money goes toward chillers, coolant distribution units, piping, and air handling units. Beyond the equipment, the physical structure itself requires capital. The building shell and civil engineering work account for another $2.0 to $3.0 million per megawatt. Finally, getting everything installed and running involves mechanical, electrical, and plumbing labor. That labor, along with the final commissioning process, costs roughly $2.5 to $3.5 million per megawatt. We can apply these unit economics to the broader construction pipeline. The announced pipeline for 2025 through 2027 shows roughly 60 to 80 gigawatts of new IT capacity planned globally. When you calculate the cost of that capacity, the total addressable market for equipment and services through 2027 reaches a cumulative $700 billion to $1.1 trillion. To understand the scale of this spending, consider the impact on smaller vendors. For a mid-cap company in the industrial sector, Durably capturing just 1% of that capital pool represents a thesis-defining outcome. Asymmetric plays, where mispricing persists. Let us shift our focus to asymmetric plays and examine where mispricing persists in the market. We need to distinguish between two distinct groups of stocks. The first group consists of high-quality but priced-in names. At their current multiples, companies like VRT, ETN, and GEV fit this description. You can still hold these stocks in your portfolio, but the easy money has already been made. The second group involves asymmetric setups. In these situations, consensus models still treat data center revenue as a standard cyclical trend rather than a structural shift. Alternatively, the broader market has not yet capitalized a company's multi-year backlog visibility into its PE ratio. We will now walk through 4 specific candidates that screen as compelling options under this second framework. GE Vernova, GEV, gas turbine pricing power. Let us look at GE Vernova, or GEV, and their pricing power in the gas turbine market. The setup here is straightforward. GEV has completely sold out its heavy-duty gas turbine production slots through 2028. Right now, they are negotiating delivery slots for 2029 at materially higher prices. Every time they ship a turbine, it creates a long tail of high-margin service revenue. That service revenue compounds at approximately 7% per year. Additionally, their grid solutions segment, which covers high-voltage direct current and transformers, entered 2025 with a backlog up greater than 40% year over year. This stock still presents an asymmetric opportunity. The broader market understands that GEV is a solid business right now. The real debate is about the durability of this demand. Bearish investors assume turbine demand will simply normalize by 2028. We see a strong counter-argument to that view. Even if AI CapEx suddenly flatlines, the United States still needs to replace its aging gas fleet from the 1990s. When you combine that replacement cycle with growing LNG export capacity, you get a solid 10-year demand tail. Furthermore, those booked service contracts remain largely insulated from standard CapEx cycles. We have to monitor the risks that could break this thesis. I would change my mind on this setup if we see the cancellation of greater than 2 gigawatts of announced gas turbine orders. I would also change my stance if there is a step change in small modular reactor delivery timelines. Specifically, if those SMR deliveries pull forward to 2027 to 28, that would significantly alter the overall market outlook. Quanta Services, PWR, the picks and shovels integrator. Let us turn to Quanta Services, which trades under the ticker PWR. We view them as the physical integrator for this entire infrastructure build-out. PWR operates as a primary specialty contractor for high-voltage transmission in North America. Every behind-the-meter power purchase agreement, new substation, and interconnect project requires a contractor like PWR to do the heavy lifting. There are very few alternatives operating at this level of scale. Competitors like MYRG and MTZ hold the next positions in the market, but they carry much smaller backlogs. Meanwhile, PWR currently sits on a massive backlog of approximately $35 billion, and that figure continues to grow. We still view this stock as an asymmetric setup. Right now, the broader market values PWR like a standard cyclical contractor. However, their actual revenue mix is becoming increasingly recurring over time. They are actively securing master service agreements with regional utilities and signing multi-year framework contracts. Because of this shift, we believe the consensus estimates for 2027 structurally underappreciate their combined exposure to both data center construction and broader grid modernization. We are closely watching for specific signals that would change our thesis on this company. The main operational risk here is sustained labor cost inflation. If rising labor costs compress their gross margin below 13% for 2+ quarters, that would force us to change our outlook. That specific scenario would signal that the company can no longer pass its increased costs through to its customers fast enough. Vistra, VST, and Talen Energy, TLN, behind-the-meter nuclear. Let us examine the behind-the-meter nuclear opportunity, focusing on Vistra, which trades under the ticker VST, and Talen Energy under TLN. The setup for both businesses is quite straightforward. They both own existing nuclear generation capacity. Vistra operates the Comanche Peak facility, and Talen operates the Susquehanna plant. Both companies have the ability to sell this generation directly to hyperscalers at premium prices. They do this through behind-the-meter power purchase agreements. Talen already has an Amazon deal in place at Susquehanna, and Vistra holds similar optionality at Comanche Peak. These direct sales represent the highest margin electrons generated across their respective fleets. This situation remains an asymmetric play. It is true that both of these stocks have run hard recently. However, the market consensus still values their nuclear fleets at a replacement cost of approximately $2,000 to $2,500 per kilowatt. We need to look at the actual economics of these direct deals. Behind-the-meter power purchase agreements priced at $80 to $100 per megawatt hour imply strong 25-year cash flow streams. If you extend those cash flows across their entire fleets, the math supports valuations of $4,000 plus per kilowatt. The gap between the current market value and that higher number simply represents the option value waiting on regulatory clarity. There is a specific event that would change our outlook. The central risk here revolves around the Federal Energy Regulatory Commission. Specifically, we are looking at FERC's November 2024 rejection of the Talen and Amazon Interconnection Service Agreement amendment. If the FERC framework hardens against these co-located, behind-the-meter arrangements, our thesis weakens materially. A hardened regulatory stance would force these nuclear plants to sell their energy back into wholesale markets at standard locational marginal pricing. Because of this structural risk, it is highly worth monitoring the outcomes of the recent FERC technical conferences to understand where the regulations are ultimately heading. Smaller cap setups, POWL, FIX, NVT. Let us move down the market cap scale and examine three smaller setups. These companies are Powell Industries, Comfort Systems USA, and nVent Electric. Powell Industries, POWL. We will start with Powell Industries, POWL. This company manufactures medium voltage switchgear and prefabricated electrical buildings known as e-houses. Data center operators increasingly use these e-houses to speed up their facility construction. Powell has seen significant demand, and their backlog has tripled since 2022. The stock has run substantially over that time. However, it still trades at a discount to its large-cap electrical peers despite delivering higher growth. You do need to weigh a few specific risks here. The stock has a small float, and their order timing can be lumpy. Additionally, their legacy exposure to the oil and gas sector still remains at approximately 40% of their overall revenue mix. Comfort Systems USA FIX. Next, we have Comfort Systems USA FIX. They operate as a mechanical and electrical contractor. Compared to their peers, they utilize a highly active modular construction strategy. This approach has successfully grown their technology segment, which covers data centers and semiconductors. That specific segment reached approximately 37% of their total revenue. For context, it accounted for less than 15% of revenue back in 2020. Their valuation multiple has expanded alongside this growth, but it remains below the benchmarks of comparable, high-quality peers. The primary risks for FIX involve basic project execution and broader labor availability. They also carry customer concentration risk within the technology sector. nVent Electric, NVT. Finally, let us look at nVent Electric, NVT. This business produces liquid cooling manifolds and electrical enclosures. They recently acquired TRACT and ECM Industries to intentionally build out their exposure to the data center market. Wall Street covers NVT less frequently than competitors like VRT. However, NVT offers adjacent product lines and trades at a lower multiple. The risks for NVT stem from their smaller overall scale and the execution required to integrate those recent acquisitions. Furthermore, they currently have fewer direct relationships with the major hyperscalers than an established incumbent like VRT. Risk assessment. We need to look closely at the risk assessment for this thesis. We organize these risks into two distinct categories. The first group involves broad market and cyclical risks that affect the entire thesis. The second group covers risks tied to specific companies. Let us start with the broader macroeconomic picture. One major risk is a broader recession or a rate-driven pullback in capital expenditures. We assign this a medium probability but a high severity. If this happens, it would compress valuation multiples across the entire sector. In that scenario, balance sheet quality becomes crucial. Another broad risk is a cut to hyperscaler CapEx. This could happen if AI monetization disappoints in the 2026 to 27 timeframe. This also carries a medium probability and high severity. Every stock in our thesis would re-rate lower under this outcome. However, equipment vendors with long lead times would have more insulation due to their existing backlogs. Moving to operational pressures, we see a high probability that skilled labor inflation will outpace pricing power. While the severity is medium, it directly compresses the margins for contractors like PWR, FIX, and EME. Equipment vendors remain much less affected by this specific issue. We also monitor geopolitical factors, such as Chinese retaliation involving commodities or rare earths. This presents a medium probability and medium severity risk. It primarily exposes the supply chains for transformer steel and copper. We view this as a multi-quarter headwind rather than a multi-year disruption. On the regulatory front, power tariff reforms have a high probability of occurring. The severity here is low to medium. Shifting costs onto retail customers slows down new grid connections. Interestingly, this dynamic actually favors the behind-the-meter solutions we discussed earlier. Speaking of behind-the-meter setups, regulatory action from FERC remains a critical factor for nuclear operators like VST, Talen, and CEG. We consider the risk of FERC blocking co-location as already partially realized. The severity for those names is critical. A block forces these nuclear plants to sell their power into the wholesale market at standard locational marginal pricing. That completely removes the premium economics of direct power purchase agreements. Finally, we have specific risks tied to the gas turbine market. We see a medium-low probability of customers canceling 2030-plus turbine delivery slots. The severity is high specifically for GEV. We must monitor their order book disclosures closely, though their ongoing service revenue provides a cushion on the downside. A related, though low probability risk involves small modular reactors. If SMR delivery timelines accelerate dramatically, it would compress the broader gas turbine demand cycle. However, we see this scenario as highly unlikely before 2029. Name-specific risk summary. Let us drill down into the specific risks for the individual companies we just covered. Starting with GE Vernova, their robust service backlog provides a strong financial ballast. However, the pricing for new equipment acts as the main swing variable for their future margins. We must also acknowledge that their offshore wind segment remains an ongoing drag on overall performance. Moving to Quanta services, we are closely tracking their active acquisition strategy. Buying companies like Cupertino Electric naturally introduces integration risk into the business model. Because of these recent deals, goodwill now makes up approximately 30% of their total assets. When we look at Vistra and Talen Energy, the primary concern is single asset concentration risk. This risk is directly tied to their marquee power purchase agreements. The regulatory outcomes from the Federal Energy Regulatory Commission regarding these deals are entirely bimodal. The companies will either secure those premium economics or they will lose them entirely. For Powell Industries, the operational risk centers on their project pipeline. Their current backlog is heavily concentrated among a handful of large customers. If just 2 or 3 major projects slip past a deadline, their quarter-on-quarter financial optics will suffer disproportionately. Comfort Systems USA faces a similar dynamic. The heavy technology exposure that drove their recent re-rating now acts as a concentration risk in reverse. If hyperscaler contract awards begin to slow down, their valuation multiple will compress much faster than their industry peers. Finally, nVent Electric holds a less defensible product position when you compare them to a market leader like Vertiv. While nVent has captured real market share recently, we do not yet consider those gains to be permanent or structural. Bottom line, The AI build-out has officially shifted its primary constraint. The bottleneck is no longer silicon. Instead, the constraint is now substations. Hyperscaler CapEx is currently tracking toward approximately $700 billion in 2026 across the four largest buyers, which are Microsoft, Meta, Alphabet, and Amazon. Furthermore, the multi-year forward order books at companies like GE Vernova, Eaton, and Vertiv now extend well past 2027. This data indicates that the value pool is migrating downstream. Capital is moving away from accelerators and directly into the physical infrastructure layer. We also need to evaluate regional grid delays. Right now, there is a 5 to 8 year grid connection backlog in territories like PJM and AirGrid. Many market observers view this as a bottleneck. However, we view it as a structural moat for incumbent equipment vendors. These connection queues now stretch far beyond standard data center construction timelines. This delay forces hyperscalers to make specific expensive choices. First, they have to bring power generation behind the meter. Second, they are forced to pay premium pricing for any in-stock high-voltage equipment. Third, they must sign multi-year framework agreements to guarantee future capacity. All three of these market dynamics directly expand profit margins for infrastructure suppliers. This setup brings us to our final conclusions and stock selections. We have identified several asymmetric plays where we hold high conviction. GE Vernova stands out due to its gas turbine pricing power and growing grid backlog. Quanta Services remains the definitive transmission integrator for this build-out. Vistra and Talen Energy present compelling opportunities driven by their behind-the-meter nuclear agreements. We still track Eaton and Vertiv as high-quality names, but their current valuations are fully priced. We also see distinct value in underappreciated names like Powell Industries, Comfort Systems USA, and nVent. The shift toward data center revenue is very real for these smaller cap companies, but current sell-side models do not fully reflect that growth. Finally, we must ground this thesis by acknowledging the primary risks. First, we face a potential CapEx revision cycle. This would likely trigger if AI monetization disappoints during the 2026 to 27 timeframe. Second, the market could experience a gas turbine oversupply if buyers suddenly cancel their 2030 delivery slots. Third, there is an ongoing threat of regulatory pushback against nuclear power purchase agreements. We saw a clear example of this risk when FERC rejected the Talen-Amazon agreement expansion in late 2024. Fourth, labor inflation in the skilled trades remains a persistent headwind. Rising labor costs could cap the margin expansion we expect at the integrator level. Disclaimer: this report is provided strictly for informational purposes and does not constitute financial advice, an offer to sell, or a solicitation to purchase any securities. Readers should conduct their own due diligence or consult a licensed professional before making any investment decisions based on this data. All information is sourced from public filings and is considered current only as of the date of 21 May 2026.